For today's video, our topic is the yield curve, or the U.S. Treasury yield curve, as that's been in the news a fair bit in recent weeks. A yield curve is just a graph or a picture that kind of demonstrates the relationship between interest rates or yields and the length of time or the duration of a contract. For a sample, I have a copy of the U.S. Treasury yield curve from approximately a year ago. We have time of the note or bond along the bottom. We have interest rates along the side, and as you can see, the shorter term bonds or notes have lower interest rates than the longer term bonds or notes, which kind of makes sense. If you were going to borrow money yourself, interest rates for a longer term loan would be higher to reflect the uncertainty for the lender in terms of inflation or economic policy or what have you. Last year, the Federal Reserve increased interest rates several times, bringing up the short end of the curve and really flattening the curve overall. When we take a look at the current yield curve, you can see here that short-term interest rates, say here at 1 or 3 months, are very similar to rates in the middle section of the curve at 7 or 10 years, although there still is some steepening at the end of the curve at 20 or 30 years. Why does this matter? Well, there are some economists out there that believe when the yield curve goes through a sustained inversion, where interest rates at the short end of the curve are much higher than interest rates at the long end of the curve, that can sometimes predict recession. Fortunately, the Federal Reserve has actually paused on any interest rates for the remainder of the year, making such an outcome very unlikely. For more information, subscribe to our blog or go to our website at hfaplanning.com.